Hey investors. Now, hotel investing is something kind of new to me, I'll be honest. But I've been doing my research and more importantly, getting myself around the right people. But what I wanted to do in this video is break down some of the basics on hotel investing. And I'm going to be going through this article that the team put together and adding a little commentary. And the way I would use this video is watch the video, maybe pause the video here, there, read the article, and then hopefully I fill in the blank spots as we move along. But yeah, why hotels? I think the idea initially when you're going after workforce housing or Class B and C apartments is that you're going after a commodity where the majority of renters are lower middle class type of demographic. Now, hotels are obviously a discretionary type of item. For example, I think everybody, I don't want to say everybody, I don't want to be insensitive here. A lot of people go on vacations. And when they go on vacations, they go on hotels. Through the pandemic, shut things down in terms of travel and hospitality. But as we come out of the pandemic, the signs are clear that the hospitality is going to be on fire, and there's a lot of pent-up demand. Despite what you may read in blog articles, the newspaper, or YouTube videos that are trying to sell attention, a lot of the big industry news are seeing that hotel investments are on this curve of recovery, whereas other asset classes, actually, let me bring this over, drawing this the other day, and I'm not saying that this is 100% correct. And the whole idea is that you have different asset classes, such as we do a lot of multifamily. And I think the reason why I like multifamily is it's an industry that you can't really disrupt. You can't really go out and build a whole bunch of apartments just anywhere. And whereas industrial, for example, is coming up on this trend line, going through recovery. And the problem with industrial, it is a disruptible industry, right? If Amazon decides that, hey, we don't need all this warehouse because we're just going to use the new Rivian trucks and just deliver stuff and just take out the need to store stuff. I'm not saying that's true, but I'm just using that as an example, how businesses can change. Whereas everything on here, the way I look at it, multifamily and single family homes, it's a boring asset class. The trouble is a lot of institutions have come into the space because it has been a very good safe haven for other asset classes, especially office. Office is still in the trough, coming out of recovery. And I think we all beat up on shopping malls, for example, whereas the strip malls are a little bit different. Your neighborhood, grocery anchored, where you've got your little eateries, your barber shop, your beauty shop, that type of stuff. That I think that's always going to be around. Still disruptible, of course. Kind of an image, market cycles go up and down, and institutions, the way they look at it, especially a big private equity firm like Blackstone, they're constantly moving in and out of these asset classes as it kind of moves along this threshold. And this is why I just put this together, how I think of the market. And I know a lot of you folks out there look at a graphic like this, you really geek out on it and take it as gospel. Please do not do this. This is just a mind map of where I think are things out there. And I'll highlight the hotels down here. Right? Hotels you're starting to see the life come back in it. And the nice thing about hotels is when things are really good, man, are you killing it in terms of returns and cash flow. And we'll get to some of the basics on that a little bit. Now, hotel investments may not fit your investment philosophy, but what I tell people a lot is, and they probably think they go through a lot of the content and they're like, I want a Class B asset in a minus area. All right, cool. But you're not going to find those. There's not really one investment that really fits all your investment criteria. And therefore, as an investor, you're going to have to bring up a scatter plot of all your investments and diversify into many deals and investments. I always tell my investors, the general rule of thumb I have is don't put more than 5% of your net worth into any one deal. And you may be looking for more of a conservative type of investment, such as a stabilized, light value add multifamily play that's cash flowing from the start. And you're just fixing up light upgrades, such as the flooring, the appliances, new paint jobs, stuff like that. But follow me here, right? Because there's this concept of an asymmetric risk. Now, asymmetric risk is something that a lot of high net worth investors will consciously do. And we're talking guys over 5, 10 million plus, where they are taking a small minority portion of their portfolio, maybe about 1 to 10%, and they're going after flyers. Now, this asymmetric risk play or flyers, if you want to use that word, it can range, right? Things like venture capital businesses or altcoins is definitely on that high end spectrum where you're probably going to lose your money 90 something percent of the time. But if it does hit, you make 20, 50, 100x plus. I still think that hotel investing, and it's still on that scale of more stabilized, safer asymmetric risk play. The returns of multifamily, especially when you do light value add, they're great. But I think when you see, at least what I see from myself and other higher net worth investors, is it gets a little boring, right? Imagine if you had $4 or $5 million net worth, then you had a few $1,000,000 in that into deals, and you maybe had $1 million that came from the banking, and then you're maybe bringing in anywhere from $250,000, $500,000 of passive income every month. You have your bases covered for most people out there. Some people have pretty extravagant lifestyles, and that's okay if you have the cash flow to pay for it. What do you do when you don't really need the money to live and eat and breathe off of? You put some portion of your net worth, maybe let's just call it 1 to 10%, into these types of more flyer projects. I don't like altcoins at all, but that might be your thing. If you're a little bit more conservative, I would say still put it in things that are hard, real, tangible assets that provide cash flow. And that is what the asset class of hotels are. And before we get going, we're not talking about timeshares. I'm hugely against timeshares, or something where a lot of the hotel brands will do when they get a big brand, such as the Hiltons. I think the Marriotts will do this too. A lot of that is they'll create like a hotel cluster and they will sell the timeshares. And the timeshares is where they make a huge amount of their money, a lot of it because of their branding. Don't be that sucker that invests in timeshare. You don't even own it that long. I think most of the contracts last 30 years or something like that. And you don't have the losses. It's ordinary income. Friends don't let friends do timeshares and 1031 exchanges for less than a quarter or $1 million capital gain, as I always joke around. This is where you're going in as an equity partner with a piece of the upside. Maybe this isn't the best type of analogy, but if a lot of folks in our investor group are Golden State Warriors fans because they live in the Bay Area, because they make a boatload of money as in the tech world, and the Golden State Warriors with Seth Curry and Klay Thompson, they shoot a lot of threes. And as the saying goes, live by the three, die by the three. And in terms of growth, we're going to be defining these terms a little bit later, but RevPAR, average daily rate, or ADR, greatly surged in times of high traffic. I think one of our partners, we got a Comfort Inn in Times Square. We was out there last month, and it's a couple $100. It's very small and really nothing that great. The location is great, which is why we good low cap areas, which is counterintuitive to what we've been saying, right? Low cap rates means that it's lower cash flow areas, which is why we go to a higher cap rate asset class. But the low cap rate is talking about how conservative and safe the location is. Low cap rate areas, if you don't know, like New York, Los Angeles, Seattle, Hawaii, the reason why they are low cap rates is because they are deemed very safe type of location investments. They will always be that top tier market. Where some of the other markets that we've been more known to go after, the Phoenix, the Houston, Dallas, those are more secondary markets, so you see higher caps. They're not the coolest, baddest gateway cities out there. Of course, they're still better than the tertiary markets, which you've moved away from these smaller, less than 500,000, 250,000 population type of towns. Certainly, we stay away from anything under 100,000 population. But just like how RevPAR and average daily rate, going back to that Comfort Inn, that's $200 a night that I went last month, and that was in the shoulder season. You go to that high peak season, now you're looking at like maybe $500, $600 plus in that Times Square, that parade that they do, or they're dropping the ball. You're talking maybe 5x your normal daily rate, and that's when you're making a killing. And it's very similar to like the surge pricing on Uber. If you get out of a music concert or a sporting event, you're paying like sometimes double or triple what you normally pay for your Uber. Same concept, and it's all automated. A lot of these systems are very standard and automated, this dynamic pricing surge. But the one thing is with hotels, they are a more operationally intensive business, such as like people ask a lot of times, like, hey, do you invest in assisted living facilities? Great demographics. The baby boomers are going to be retiring, and just makes total sense. But I tell people, no, I stay away from like a 10-foot pole for the most part, because it is a heavy, intensive business on the operation. It is not like just running an apartment building or a single family home rental. It is a lot more invasive in terms of management, responsibility, and hotels like that, right? Because you think of the churn, you have staff, you have the housekeeping staff, the maintenance staff. Things are going through more wear and tear. Hotels are as much as an operational play. That's certainly not as much as assisted living, but I think you guys get the point here. Luckily, there are a lot of sophisticated property management companies, and that's the kind of the key thing here. Not the asset management company, but the property management company, people who are boots on the ground. And the nice thing is, like mobile home parks, assisted living facilities, they do not have like really institutionalized vendors or property managers I don't think ever, or not yet. I think assisted living facilities, they're getting there. But certainly mobile home parks, if you're a mobile home park operator, you're SOL. You're not going to like look up your mobile home park industry conference and find the best regional property management out there. They're not. You have to go build your own management team. But this is not the case in hotels. A lot of big national firms out there, just like how we do with apartment, very similar. And that's nice, because when there's a lot of competition, we as the asset owners and asset managers, we have the ability to, if somebody's not performing, we can go to the other 2 to 5 other people that are just as good and negotiate a contract or keep them accountable because of that competition aspect. And this is a side thing, right? Like, I think we can all agree that a lot of our friends and family think of us investing in these Class B and C apartments as boring. Boring is a good thing. At least I think it is, especially when you're talking about like boring cash flow coming in. But isn't it cool to say you own a hotel in a well-known area? People have actually gone to some of these apartments are outside the city. There's thousands and thousands, millions of apartments out there. Not really that special. So if you're one person who buys chocolate farms and cocoa farms and coffee farms, I don't know who would do that. I've actually bought those myself, so I'm just joking. But part of this is fun, and you get to a point in investing where you might want to throw in some trophy assets, and that's what I personally do a little bit. So going into different types of hotels here, and these are the different types, and there's different brands that fit into some of these types of hotels. But you've got your full service ones, your limited service ones, and your full service ones are your more resort. And a lot of these are ranked on like a star rating or a diamond rating. So your 5-star will be your pretty nice hotel. I would say like most Hiltons are either old ones are 4 or 5. A Four Seasons, typically a 5 or 6-star or diamond, or I forget what they use. These other hotels, such as like the budget hotels, now there's a big range here because there's a huge demand for this type of stuff, especially from the corporate traveler or the more budget constant traveler these days, like the family with their $100,000 a year or less job. Like, they can't afford $1,000 a night at the Four Seasons. They can't afford $600-700 at the Hilton. But there's these range of budget hotels, and on the high end of the budget hotels are the Hampton Inns. And I would say on the lower end or the middle end would be that Holiday Inn, Holiday Inn Express. When I was, living on the road as a construction supervisor, I stayed at a lot of Best Western, which I probably call maybe a 2-star. Some Holiday Inns are nicer, so you might call them those a 3-star, 3 diamond. But these are the budget hotels. Typically, they have the added benefit of free Wi-Fi and free breakfast, which is always a nice thing because unsophisticated consumers always like that kind of stuff. And just for your own knowledge, the cost of that breakfast is somewhere, I think, between $5 to $7, just in case you're wondering. And another rule of thumb is to have a change out in terms of like somebody clean out the unit or housekeeping. Usually about $25 for a change out. So the expenses are a little bit higher than apartments, obviously. But with apartments, it takes us like several years to really cycle through all the units and get the rent bumps. And it's very steady, but extremely slow. Whereas you could have an entirely different set of tenants as they move in today, maybe out tomorrow, or certainly out in a week. you can bump up those rental rates pretty much instantaneously, and it's all done automatically through automated systems. Extended stay hotels, now these range too, but these are typically more like the 1.5, 2-star, and these are days in. I was mentioning, I would say that's more of a lower budget hotel. I stayed in a lot of these crummy places. I've had bed bugs myself in some of these 1-star places, so I know all these brands. I was not a lot of people think that I was some kind of like computer programmer or some kind of consultant for some fancy company. Not the case. I was in construction, so we stayed in crappy Best Western, and I was actually very loyal to the brand because I love my points. The corporate orders love their points. But there's these extended stay hotels where you can get more of a weekly rate. But if you've seen these things out there, you're familiar with them. But maybe you're not familiar with this last one here, which is that homeless shelter or government buy. There's a lot of need for low income, Section 8, temporary housing, men's, women's shelters, children's shelters, all variety of reasons why they need them, and they're paid for not just one part of the federal government's budget or department, but several different. So there's several different programs that I was made aware of, and like homeless shelters will house the homeless, whereas in some other areas there are like projects which are more like lower income or long-term type of stuff. Depends on what's out there. It might maybe cheaper, especially on a temporary basis, right? Like a 1 to 5 year type of thing for a municipality to buy out an entire hotel, and kind of just some of you guys have Section 8 houses, same thing. It's just pretty much a complete buyout. You don't have to worry about the tenants paying the rent, and then a lot of this is very negotiable. They talked about some of the mid-tier examples here. Homewood Suites, I would say, is a little bit nicer than a Hampton. I would call it maybe a 3.5. You guys can read what's included in these types of what the typical amenities are, and I'm sure a lot of you guys have stayed in hotels and understand this type of stuff a little bit. But from a high level, hotel investing strengths, mobile workforce and less adventurous travelers staying more in hotels. So this was a big when the Airbnb VRBO came out, right? Airbnb VRBO is going to kill hotels. Not the case. A lot of places, especially like in Hawaii here, and you go look on the app, there's blackout areas where there are absolutely no Airbnbs allowed in certain areas. And the mobile workforce wants to get around. They don't need to stay in one place. The one thing that people want to do is travel. And the more a hotel and traveler is a little bit more or less adventurous, right? I think when I was younger, I liked the Airbnb because it was cheaper, but now I'm seeing that it's pretty much the same price. And I kind of made a rule at one time. It's a funny story. I stayed in an apartment in Atlanta for $70. And this is the early days hunting for deals. And I was super cheap. I was single, and it was like a super ghetto place. And it just felt so comfortable. I normally will check in and then get some food. I just stayed there. I just intermittent fast the whole night. It was horrible. And personally, after that, I made a rule to myself that whenever I went on Airbnb, I was always going to spend more than $150, $200. And that kind of just illustrates the issues with Airbnb. It's all over the place. You have a lot of unprofessional, unsophisticated mom and pa's, and especially with all these random like gurus teaching you can be rich with a short-term rental on Airbnb VRBO. And the reason why they have those types of things is because, quite frankly, the market has gotten so hot that just regular rental properties, long-term rentals, don't really work, especially in like places like California, Seattle, all these low cap type of areas. Doesn't mean that it's a good investment. And I think we've seen the trend move back. And I would look at this video right here. It was pretty insightful to learn about the brands and why, like the Airbnb VRBOs are getting a lot of pushback against governments. They're finally having to pay the same taxes as the big guys, the hotels. And then you also got to think the hotel industry is very consolidated. The only person that's going to fight for this other stuff is Airbnb VRBO. I put my money on the big hotel industries personally. The other point here is, like we said, dynamic pricing allows prices to surge. You really make a killing on non-discriminating clientele. These are the guys that where I was. You're a corporate warrior. You're on smelling the companies. You don't care, right? I did it all the time. I stayed in the Best Western, and because I wanted my points so I can buy my gift cards and all the stuff that was like fringe benefits that I didn't have to get taxed on. Baby boomers traveling more. The internet allows people to, move around more freely, and I think it opens up general travel for everybody. And this is the big thing about brands in the hotel industry. People stay in hotels for the brands. If you are otherwise and you want that kind of adventurous, like little boutique type of hotel, you're definitely a minority. People go, especially when you're going to a city or town you've never been or you're unfamiliar with, which is like most times for most people. And again, we're talking about most people here. I think a lot of you guys listening, and myself included, are a little unique characters, which is why it's cool to come out to Hawaii during our annual retreat and hang out with our other crazy people who are counting the days number to working their day, getting as much good debt as possible, not doing their 401ks, maybe renting a house like I do, not buying a house to live in. But anyway, like, you have to think of what the general public do, and they go after big brands like Intercontinentals, which are the Holiday Inns, the Hilton, the Hyatts, and there's all these other kind of sub-brands off of the major parent companies. Again, the video will talk about a lot of the other brands, which you may have been aware of, is like Hilton or Hyatt. One good thing is you're not working with kind of low-end tenants, and this is why we've went away from Class C apartments. Some of them, especially in the pandemic, we had 80% collections. We're pretty much full, like 90-something percent, low 90%. There are a good 10% of the people, at least 10-15% of people that weren't paying. Not the case with this type of stuff. No food stamps accepted, no social security. Of course, if you are working with the government agency and you've got that kind of worked out. And by the way, when you are doing like a homeless shelter or one of those government arrangements, the government will buy out the entire thing typically. You don't want to mix for obvious reasons. And tenants, like I mentioned earlier, are not sticky. They typically move out in 2 to 3 days, whereas normal apartment tenants or rental property tenants naturally turnover in 2 to 3 years. Hotel clients are in and out. Complete control over upgrades and pricing, and then great potential returns in other asset classes. Some of the weaknesses, I think Airbnb or VRBO definitely competes on the low end areas. And I don't know if I really want to compete in some of these areas where there's no government regulation, where they let Airbnb, VRB owners do whatever. You're going to have a lot of competition there. And a lot of areas where, but I think at some point, like I said, I think people are going to understand that VRBO, Airbnb are very inconsistent products, whereas the hotels have the economies of scale, the reliability. Think about all their units are right there. They're using all the same boiler systems, the same. They've got all their parts. The person goes around with a cart, as opposed to the cleaning on the Airbnb is so cumbersome, and there is a huge markup on that, going and servicing those. It's just a matter of time before the general trend catches up. And I think it already has, because these municipalities have found a way to tax these types of guys and put the regulation on Airbnb guys. Very similar to I was in San Francisco earlier this year, and apparently it's cheaper to take the cab because the Airbnb gets killed with all the taxes, and it's actually it's cheaper to go the traditional cab way. And then, of course, the bad thing about hotels is, if the market turns, travel and leisure and personal budgets constrict this discretionary spending. Definitely something to be aware of, but it depends what your opinion is of the market. I would say most investors who are more vocal are on the dooming, but I would say majority of sophisticated investors are quietly seeing the opportunity of this roaring 20s upon us. If you follow a guy like Richard Duncan, we live in the era of creditism, where essentially governments, especially the United States, which kind of controls the monetary policy, can just continue to print the money after money. At the end of the day, just like an apartment, it's a building, and you can definitely repurpose it if you need to, but it's a hard asset. And this is why I don't really invest in altcoins, even crypto or Bitcoin. I think I have less than like $5,000 in that type of stuff. But the case I'm making, or at least what I do personally, is I don't see like multifamily being, I don't see hotel investments being the majority portion of my portfolio, but I definitely want a small portion. Part of it, like I said, to me is like the trophy asset, but the other is, man, these things make a killing. And if you can get the right data to underwrite this stuff, and which we'll go into here, things that the underwriting with Star Report, and you can run your numbers conservatively to ensure that you do make it through tough times should they come, or we should say when they come. In the hospitality world, they have this thing called a star report, and you guys might have heard that on the apartments, we will use something called the CoStar report. Extremely similar. In fact, I was looking it up just now. The star report just got bought out like recently, and CoStar, if you don't know, is this big conglomerate. They have extremely good data. It's pretty much a monopoly. Jeff Goldblum does all their commercials, but they also own apartments.com. So apartments.com is their customer-facing side of the business, whereas the commercial side, our side that we use, and a lot of these subscriptions, I think it's 5 figures to buy one of these. So no, you guys at home can't just access the CoStar report or the star report. But we definitely have access to this, and we do use this data. But here's we do have embedded here a example of how to use the thing, and you can get a sense of the level of detail. Of course, you got to do your due diligence as an operator, and we do spot checks and validate these numbers because data is data, and sometimes it can be off. You got to go in with a brain and verify this stuff with boots in the ground, checking out comps, and then just being another layer of conservative from there, just like in any type of. But here are a few of the terms and definitions. Average daily rate is ADR, and this is a measure used in the hospitality sector to show the average income produced for an occupied room on a particular day. It's one of the key KPIs, and it shows that a hotel is making more and more money from the rentals. The greater the ADR, and the ADR is the formula is revenue from rooms divided by room. The other type of statistic that is similar but different is this RevPAR, revenue per available room. You guys can read this more in detail, but it's used to measure hotel performance, is revenue per available room. The average daily rate of a hotel room is multiplied by the occupancy rate to get this figure. So the occupancy rate is, as you would think, it is the number of heads and beds that night. I would say some of the differences between hotels and apartments. In apartments, we normally say 90 to 95% occupied is full, right? You don't want to go over 95% because that means you're just not charging people enough, silly. That's why we like to buy these apartments at 100% occupied, because it's a clear sign that the owner is just not being aggressive with their rep bumps. But in hotel investing, these properties don't go as hot, they don't go as occupied, and you want to leave some room in there for those surging nights. So, to kind of make the slider go backwards a little bit from apartments, 80 to 95% is that sweet spot you want to be. Now, some people that, not going to say names, that we like to buy from are not the best operators, and they may prioritize occupancy rate over average daily rate. They would rather see the property full than to have the average daily rate high. Personally, and through conversations with a lot of smart people, partners included, we're aligned. What we want to do is keep that occupancy rate in this nice little sweet spot range, 70 to 85%, but we want to maximize the average daily rate. So I guess what you don't want is, you don't want the occupancy rate to be like 90, 100%, but your average daily rate is low because you're just trying to fill units. And when you fill these units, you have a high occupancy rate that generate $25 per unit change out, as your housekeeping staff have to turn those rooms, and then all the kind of additional wear and tear on your property, more breakfasts to serve. Right? There's a sweet spot here where you're getting consistently to get that surge pricing, and you don't really maximize the asset, which is a little counterintuitive. But I would say read this article a few times and you'll get the concept. RevPAR is similar to ADR, and some people will say that RevPAR is the same. To me, it's like arguing back and forth between, I guess I can't think of anything, but two things that are similar at most nine times out of 10. It's just semantics, depending on how you look at things. So I guess here's one thing, like when we do underwriting on apartments and we say we're going to bump the rents up maybe $200, I might underwrite that as the occupancy will take a drop the first year, second year, and go up to the third year. Somebody else may underwrite normal normal occupancy in the 85 to 90% range, but then they won't bring those total potential income up or those average rents up right away. They'll do it over 3 years. Same thing at the end of the day, but it's just two ways to kind of look at it. So when we're playing around with the numbers, it's one or the other. Personally, the way the team, I do it and the team does it, manipulate the ADR and occupancy. There's two of the biggest KPIs in the underwriting. Of course, we're using the data from the STAR report and also benchmarking other properties that the property management owns that we'll also own to also come up with that number and try to be a tad conservative with that on both. And just no different than the same mindset as on the apartments. As we always say, under promise, over deliver. You don't know what's going to happen, that there might be rocky times ahead. And that's why you want to be conservative and not assume that you're just going to run this thing at 200 ADR and 90. Instead, you probably should do maybe 165 ADR and 85%. Just random numbers out there. But I think you guys get my point. Yeah, so one thing on the occupancy is really impacted by your competition. So in these STAR reports, they'll have a lot of times your comparables in your local area. So it's always important to pick the right comps that are similar assets and in the similar area, because you might have one set of hotels showing you this average ADR, and then your hotel is here like 3-4 miles away, but it's on the opposite side of the train track. Those are the things where you need to use your brain and it makes sense of the raw numbers. But these STAR reports will also have what inventory is coming online, and new inventory coming online. Some people think it's a bad thing. It can also be a good thing, because that new inventory coming online is typically that newer A class, that 4 or 5 star, maybe even 6 star coming online. And that will definitely push the prices. Whereas if you've got like a 2 to 4 star hotel, you may not have the confidence to push it up because nobody else is pushing it beyond. For example, maybe the hotels are typically running at $200 a night, but now there's another hotel that comes down the street that, sure, it's competition for taking travelers, but they are a much higher end type of property. So their nightly rents are $450 to $650. Definitely not taking your clients away. It's just two different client sets, lower end and a little bit more mid, higher end. But what that is doing is pushing the market. It's pushing the market, and then now your hotel, the 2 to 3 star hotel, the $200, you have the confidence to push the rates up, because it's like that whole concept. You go to a restaurant, you have they call it price framing with wine. You have the really expensive bottle that nobody really does unless they get really drunk or they're really trying to impress somebody and they're just not a really good consumer. And they have that kind of the low end, and they want to price frame you to that middle. This is that same things they consider, like just like apartments, what's around, what are the attractions. It's not really that important that your hotel is really near jobs, for example. People are there because they're traveling, and typically with Uber, Lyft, public transportation or cars, people can get to where they need to go. Here are a couple big considerations that, talking with some of the team, there are 3 big things. Permitting. Some areas are very established and built out where the municipality will not approve future permits for hotels. So that if that's the case and you're buying an existing hotel, that is extremely valuable. The second thing that can, say somebody bribes somebody to get a permit. The other problem is, and you've got to build, are you using non-union workers where you can get it done cheaper, or do you have to use union workers? Now, most municipalities are on the pro-union side these days. It is a more progressive thing. We're not going to get into the politics, but when you do that, now you're building it at a much higher cost per unit. Again, it's just adding to your basis, and you're just going to have to make it up on the operation side. And the third thing is, like, a lot of these newer progressive laws require hotel operators to use union staff, like using housekeepers. Again, just like the constructions where it makes the cost of your build more expensive, this is going to make the cost of your operation even more expensive. So yeah, I think that those are 3 things they really look at, and that's going to be a competitive advantage if you're buying in and grandfathered into an existing property. Hotels, business is hard to get into because it's just one of those things. And we also talked about the cap rates. When you are going into a apartment deal, you may look for mid to high caps because you want cash flow. But hotel investing is a little bit different, I would say, because hotel investing, you're wanting a desirable area. Desirable areas have low cap rates because people want to be there. So I'm not a huge fan of buying hotels in like podunk areas like North Carolina or Bama. Get that there might be a play there, and don't get me wrong, every deal is different. I could like something that's in a very podunk 50,000 population type of town, and every deal is based on what you buy it at. But I'm just talking in generalities. Of course, whenever you invest in a deal, you're buying a one-off deal, special, unique thing, not really generalities. But just these are kind of things to be aware of. Of course, when you buy a hotel, just like when you buy an apartment, you like to find ways to add value to it to increase the operating income or decreasing expenses, and net operating income divided by the cap rate that the assets are trading at, that's the market value. Just like apartments, the nice thing about hotels, there's so much, you start to bump up those rents or the nightly rents, you start to make a change. A lot of these assets are sold today with a T6 or T12 or just a trailing 6-month financial, and it is a lot less sticky. It's so much quicker how these things move. One thing to note here, when the economy is robust and tourism and business travel are at their peak, a full-service hotel enjoys greater demand. In contrast, you'd think in a recession, demand for luxury hotels falls as travelers seek to go to less expensive lodging options. I personally think that in these more secondary and tertiary high cap, mid cap type of areas, like your Carolinas or Floridas, not Miami, of course. Miami, I don't consider Miami really like most of Florida, but the Alabama, like, like more of these country type of rural type of areas that we typically buy apartments in. You might have opportunities to buy or invest in like some of these camping grounds where people, they want that more of that outdoor experience. That might be something to invest in. I just haven't found really good operators who've done it more than like twice. And it's just not really a scalable business. Really cool business, really cool product. And because it's kind of like you're making a campground, or it is a campground, but just not really scalable, especially when you get a branded hotel and you plug it into the franchise. And it's basically what you're doing. You're buying a franchise here. And then, of course, in the pandemic, I've said it a lot of times, the high-end luxury was on fire and it was doing great because once things got going, of course, because the rich got richer, and these are the people that stay in 3 to 6-star hotels, and the B and C apartment dwellers, they don't got no money to go on vacations. So hotels are valued on 3 different approaches. I would say a lot of our modeling is, of course, off of net operating income divided by the prevailing cap rates, and that's where in the syndication e-course we talk a lot about reversion cap rates and that type of stuff. The thing with the hotels is the holds aren't at that long. You don't need to hold the asset that long because you're not going, if it's a pure value add play, it may take you 3 years, 5 years on an apartment because tenants just move out so slowly. But on hotels, you can bum rush to the rehabs and you can pretty much just bump the rents up literally overnight. That the time can be compressed quite a bit. Because the time compression is shorter, or there's a shorter time frame, your reversion cap rate is typically, the delta is less than you would, because there's a shorter period of uncertainty. There's less time for the cap rates to go up or go down. So therefore, or just an example, like apartments, we've said that maybe you want to increase the reversion cap rate 0.5 point or a full point. Let's just say a full point. That's because you're going for 5 years. 5 years is a really long time. But on an apartment value add, that could probably only take a couple, 2 or 3 years. So that uncertainty, it's a lot quicker in the future. So there's a lot less uncertainty, and therefore the reversion cap rate doesn't really need to be increased too much, because it doesn't really move too much in 2 years where it could in 5 years on an empire. So going back to some of the branding, when you're buying basically a franchise in a way, and you have the ability to change your hotel into whatever brand you want. And these franchise agreements, unlike like a Subway, McDonald's, where the franchise cut is usually like pretty big, like 8-10% on that scale. These hotel franchise agreements are very much smaller than that. Like I would say on the scale of 1 to 3%. So it is a huge deal, right? Because the brands are what the consumers go to book. Some of the things I didn't mention: high cash flow for real estate investors. Hotels are a heavy cash flow business because it's operational. There's churn, there's people coming in and out. It could be a cash as much as a value add. Pretty much same tax benefits. Cost segregations are same thing like apartments in the same building, same systems. I'd say the reason why hotel investments fares because a lot of times, like I would say, the operator doesn't pick the right ADR occupancy. There's a little bit more sunshine and rainbows on that. I still see it a lot. You see deals where they say they're going to run at 95 occupied, and I think maybe they just didn't change it over for their multifamily apartment underwriting spreadsheet or whatnot. But stuff like that's not going to happen. You could be caught in a down cycle, and I think that's where like holding adequate cash reserves and working capital is key to this. Area could be more saturated with other hotels. The thing with these hotel operators or builders, these are sophisticated brands coming in. They don't come in if the competition or the demand is not there. I would say the biggest reason is like poor management, customer service, and maintenance. If you start to get a bad online reputation, your people won't stay there. And the nice thing about Web 2.0 is, as a consumer, you know what you're getting into before you get there. The bad thing if you're a hotel operator is people know it and you can't hide your mistakes. This is why you don't want to cheap out on using a second-rate property management. One of the last other definitions here, property improvement plan. When you're on a franchise agreement with, say, a Hilton or Intercontinental, you have to play by their rules. You got to pay them their little franchise agreement fee, which I think is well worth it to basically their listing service to people book your hotel because they want to stay in a Hilton or Holiday Inn. Every so often, they're going to require from you what's called a property improvement plan or a PIP. So this is a set of standards that they're going to set for you to re-upgrade the property every so often to fit the brand's prospective image. Now, I put a couple of screenshots of actual requirements. So that below is you can see like the bed skirting, the backboard, the little makeshift desk, the drapes. This is what it looks like. And if you looked at this, you know what hotel this is if you stayed in. Here in the upper right, here's a lot what the lobby should be looking. This is just the high level, right? There's a huge stack of standard plans that I'm sure all engineers love to go through, and they've got to hire a contractor to meet these standard plans. And of course, you cite the standard plans in your construction documents. But it makes the guesswork out of like the improving. And this is where you're really seeing that it pays to pay that little franchise agreement fee because you get all this. Like, these big brands pay gazillions of dollars to get the best designs that are often optimized. Like this current plan on the bottom, great minimalistic design. Looks great. And it's also very cheap, right? If you look at like, it's a very simple construction desk. There's not really like any bed skirting there that you got to really change in and out. The headboards is just very simple, somewhat like 2x4 construction there. So they do this for a reason. Right? And I think that's why you got engineers on board to create these kind of standard plans. And at the end of the day, it's trying to make that standard stay for the people because that's what people want. They want people go to McDonald's because they want that same experience every time. Same thing with these hotels. And the PIP is negotiable. Sometimes the Holiday Inn or whatever will want something. There is room for negotiation. And it can also include everything behind the scenes, like the plumbing, electrical, guest rooms, corridors, elevators, stairways, you name it, they've got it in the standard plan. And the other thing here is we'll probably add to this resource page in the future. I suggest watching this video. It gets you an overview of all the different brands. And I think you'd be surprised which brands follow up with under which big brands, like the Intercontinentals, the Hyatts, the Hiltons are the big one. But yeah, that's kind of hotel investing in a nutshell. If you guys have any questions, feel free to email it over to team@simplepassivecashflow.com. If it's a good question, we'll definitely put it into this page. And if you guys are interested into learning more about other types of asset classes, definitely check out the syndication e-course. It's probably this page times 10. Actually, it's probably this page times 15 nowadays. There's so much stuff in here. But yeah, to get access to that, go to simplepassivecashflow.com/syndication. There's a free one up there to get you a little whip your appetite. But there is a paid course. I think it's like a few $100s that you can access to that site. But yeah, hotel investing. It's a trophy asset. If you underwrite it the right way, it definitely can be recession proof. And the upside is pretty amazing on these types of things, especially if you buy in areas where you have that competitive advantage, markets where people want to travel to.